Hi, my name's Max Phelps and I'm one of the mortgage brokers from Golden Eggs Home Loans. Today's topic is budgeting, and what we found by observing lots and lots of different people across a wide variety of income groups and whatever is that fundamentally people spend what they can access. And that seems to be the biggest problem that we have for actually budgeting and hitting our savings goals and doing the things that are actually really quite important to us in life. And so the aim of today's video is to show you how you can crack that problem. But firstly, I'm going to expand a little bit more on what the biggest barriers are besides just spending what you can access. And the first one of those is pay cycles. Now, you might say, what have pay cycles got to do with it? And actually what I've found is that if you're paid weekly, it's terrible for budgeting because you've got enough money to last every week to buy your groceries and do your spending, but bills stress you out because how do you have enough money in any given week to actually pay your bills? And especially when things like car registration and stuff is due, or even strata if you've got a property, they're big bills that really kind of stress you out. And you might say, well, okay, well, I get paid monthly and that's fine. But the problem with monthly is it's great for paying those monthly bills and having the big chunks, but it's terrible for managing the week to week because in some months you have 4 weeks and some you have 5. And so how do you manage that week to week? And the problem I hear so often is that there's too much month left at the end of the money. And so you might think, well, okay, well, I get paid fortnightly, so I should be fine. Well, fortnightly is almost the worst of both worlds because the reality is you get paid 1 week, and so that week you've got money, and the next week you don't have as much money because you've spent it in the first week because you spent what you could access. And so now you end up doing less stuff on the second week or not being able to afford things on the second week, and you end up using other things. Likewise, monthly bills are terrible because they're still too big and they still get in the way of what you can do. So what I want to do is show you a system of how to get away from pay cycles being a problem, and no matter what your pay cycle, we're going to move away from pay cycles as a way to managing your money. The second problem, of course, is cards. Now by cards, I mean the FPOS card that you use to just pay everything and access all your money, and you keep tapping it until it says there's no money left, or worse still, credit cards. Now, credit cards actually is you borrowing money from the bank. So if you think you've solved your pay cycle problems with a credit card, well, actually what you've done is you've just given yourself access to more money that you haven't even earned yet. And if you were to tell your grandparents that you're borrowing money from the bank to pay for your groceries, they would think you were insane, or they would think you're terribly, terribly poor. And the reality is you're probably not. And I know that people say, well, I get points when I spend, and the more I spend and the more points I earn. I say, well, that's all very well, but the more you spend, the less money you've got to do the things that you want to do. So why not spend less and have the money to do those things instead of hoping that they give you the money back in points? And the reality is when it comes to points, they only get about 1% return, which means you have to spend $20,000 to get 20,000 points. And 20,000 points is only just a little bit over a return flight to Brisbane for one person. That's not really going to set the world alight. So I'd rather that we move away from accessing most of our money by plastic, but we're still going to use it. We're still going to tap, but we're going to change things around. Now, the third barrier is your mobile phone. So too often these days, it's too easy to just pick up the phone and move money. So if you've got your savings account, money in your savings account, you move money and suddenly it's in your day-to-day account and you just pull it out from the ATM or tap and you can pay for it. So mobile banking is one of the biggest barriers to actually achieving our goals. So in terms of solutions, what I recommend that is everyone do, and I don't care who you are, whether you already think you're quite good or you're just terrible and you need some help, is to follow these basic principles. And that is that you need a minimum of 4 bank accounts spread across 2 banks, okay? Now that might sound a bit weird, and you will not hear this from any banks, because the last thing they want to tell you is to go move half your business to another one of their competitors. But it's something that helps you and makes you work within the framework of the world that we live in today. And when I say a minimum 4 bank accounts, credit cards don't count. Business accounts are separate. We don't count those. Investment property accounts, we don't count those. And everyone, once they understand what the 4 bank accounts you need as a minimum are, always ends up with 5 or more. So if you're running your life the way I used to run my life, which is with a bank account for every day and a savings account and maybe a credit card, that unfortunately will never ever work unless you're a complete tight ass, which unfortunately I am, but my wife isn't. So we need to move away from that structure to a different one. So let me explain the 4 basic accounts that you need. And the way that we look at this is to split out the transactions from savings. And what you need now is at least 2 transaction accounts and at least 2 savings accounts. Now, when I say 2 transaction accounts, the reason is you need one just for bills. All it does is pay the bills, but you have no card access because you don't want to be tapping at the supermarket on your bills account, because by the way, groceries are not bills because groceries are highly variable. Bills are fixed things or non-discretionary. You don't get to choose how much you spend. You've just committed to that phone contract to have electric, to have gas, to have the internet, or it's for things like doctor's bills or something like that, which you have to spend because you're not well and you need to spend that money. But supermarket, you can spend $80 on a grocery shop, or you can spend $400 on a grocery shop, and it's your choice. So we need to separate that out, and that sort of stuff is in what we call the everyday. So the everyday account is the account that you currently probably do most of your banking with, and probably currently your pay goes into and you spend everything on. The problem is if you don't separate out the bills, you don't really know whether you should be spending that money or you should be setting that aside for something that's coming. Let's move on to savings. So savings also need to be split into 2, and the reason for that is that you need to save for your long term. Now, I'm a mortgage broker. I want you to either pay off your home or save a deposit to get one. And if you're saving a deposit, that's for your long-term future. The problem is if you save for the long term in one account and don't have a separate account for the other fun stuff that you need to save up for, then there's a tendency to do one of 2 things. To either have a miserable life and never do anything fun, and save all your money for the home, and then you can buy a property, and then suddenly you go, wow, and then have a big splurge. Or worse still is that you look at your savings account and say, I want to go on holiday, how much have I got in my savings account, and spend the whole lot. Whereas when you separate the 2 things out, then you find it's much easier to know where you stand and how much should you spend on your holiday or on other fun stuff that you do, and how much should you be saving for your long term. So there's what we call long-term savings. And then save to spend actually is a whole other category. And this is where I mentioned that no one ends up with 4 accounts, because save to spend ends up getting split into at least 2, probably 3, sometimes 4, and I've even seen 5 and 6. Because if you split out save to spend, you might find that what you want is something for the fun stuff you do on a reasonably regular basis, like once a quarter, once every few months or something. And then there's the holiday, the big thing, the big ticket item that you want. You might be saving up for a car. You might be saving up for a wedding. You might be saving up for kids. And honestly, I think most people need to save what I call a buffer so that they've got money just in case. And this is different things. We know we're going to spend the money eventually, but it's just putting money in a separate account so we know what it is, we know what it's for, and it's easy to manage. Now, here's where the separate bank accounts come in, because when you actually understand mobile banking, you'll realize that actually we don't want this stuff in the same bank as this stuff. Because your everyday and your save to spend you might have with one bank, but you want a different bank to be taking care of your long-term future and your bills. And the reason for that is just simply that you if you don't have card access to your bills account and you can't see it on your mobile banking app, then you're less likely to dip into it and spend it when you shouldn't. And therefore things like cards and whatever, things like big monthly bills or big annual bills won't become a problem for you. Now this is the basic setup, and I'm going to redraw this in a second to show you how it looks like from a cash flow point of view. And by the way, when it comes to the everyday account, a lot of couples have one of these each. So you might have a his and hers account, and then you just decide who's going to be responsible for different things. But let's come back to the pay cycles. And the way to solve the problem of the pay cycles is not to get paid into your everyday account. Because if it goes into your everyday account and you can access it, that means there's a risk that you'll spend it before you've allocated it to the other accounts. So what we're going to recommend is that suddenly your bills account becomes your hub. It's where your pay goes into, and from there it's distributed. And if you make those distributions automatic, you just set up a weekly, a fortnightly, monthly, whatever transfer into the other accounts, you will find that you've got money in the everyday account when you need it. Now, the best thing about this is now for the everyday, the people that are used to getting paid weekly can get that some of their pay weekly. The people that are used to getting paid monthly can now get a weekly allowance, which is always enough, and there's always enough every single week because we have the same amount landing on the same day every single week. And the same with the people getting paid fortnightly, you're now giving yourself a weekly allowance, and it comes in automatically via internet banking. So you automatically transfer into that account. Now, I'm just going to quickly redraw this, so excuse me while I just clear the board. And this is the way that it often works for people, is that we start off with the bills account is now our hub. And the way to decide what to bill is it something where you're not going to make a choice? So it's going to be things like your rent, your mortgage, your gas, electric, phone, internet. But I also put things like doctor's bills, dentist bills, vet bills, those sorts of things go in that account too, because I'm not going to just squander money. You have your pay coming into the bills account. Now from there you make a distribution, and you normally put some into the everyday, and we do that weekly. Now if there's a couple, you might have a second everyday account for one each. Now the things that we definitely want to have in here is things like groceries, lunches, teas, coffees, the things that you do every week without fail. But there's a bunch of money that you spend which is not every day, and that's what we call the fun stuff. And the fun stuff, I find the best way to manage this is monthly. And that's simply because if you're in August, it's really simple to say, right, what's going on in August? Whose birthday have I got to buy a gift for? What wedding of friends are we going to go to? Are we going to go away for the weekend? Do I need to get my hair cut this weekend, or this month? And all those sorts of things that you can think about for the month. And of course, if you've got no other commitments for the month, then spend it on clothes and other things. But spend it, do it this way, and do it monthly. Okay? And in each household, again, you might have a bit each month, but in my household, quite frankly, my wife manages this, and that's fine. She has the money that she needs for things, and I ask her for money for those things if I'm going to actually physically spend it. Now, we mentioned holiday, and I recommend travel. I love travel. It's what memories are built on. It's what you look back on over the last 20 years of your life, and you remember the holidays. So I really, really want you to save up for holidays, and it's best to do that separately and probably in a different bank to your everyday bank. And lastly, of course, is our long-term savings. Now, when you move the money into the holiday or long-term savings doesn't really matter, but do it automatically. Now, there's a few benefits of doing this, apart from suddenly seeing where you stand with everything, so that you know every time you tap in the weekly account, you've either got money or you haven't got money. Now, if you run out of money before the end of the week, then just stop spending. Because in another couple of days, there's more money coming, and that's fine. Just make sure that you organize your day that you pay yourself in line with when you want to do the big grocery shopping or something like that. When it comes to the fun stuff, typically I would do these with the same bank. Because if you've got internet banking access and you've got money in the fun account and you want to now go and buy some clothes or go away for the weekend, all you do is transfer the money into your everyday account to be able to transact. And that's what makes life very, very easy. Again, once the fun money is gone, stop spending. Because you've spent this month's allowance, don't worry, there's more money coming next week, and you've got money week to week anyway, so you don't need to worry about not having enough for groceries. So the key to budgeting is just sticking to the amount you put in. This we don't ever want to touch. Now, there's a beautiful, beautiful side benefit to this. What you'll notice from this structure now is that there's a disconnect between your pay and your expenses. And that means it will now work no matter whether your income is highly variable or, importantly, if you get a pay rise. Now, I know that I used to have access to all of my pay, and my pay went up and up and up over time, and I still spent all of that money. But I know now that as I earn more money, as my business grows and I get more rent from my properties, then that money just builds up in other accounts. And unless I deliberately decide to change my weekly allowance or to change my monthly allowance, then I still spend the same. And that means that now what I do with a pay rise or I get with a bonus or extra income is now a choice. Do I move some more into long-term savings? Do I move more into the holidays? Do I increase the spend? But it's something I have to actually make a choice about, rather than just, oh, money came in and money went out and I don't really know how much went in and out. It's just all gone. So if you follow this system, what you'll find is it works. Now, where it doesn't work is with a credit card. Because if you use a credit card for any of this stuff here, what you find is that you then don't know really where you stand. You don't know when you've overspent your money for the week. You don't know when you've overspent your money for the month. Personally, different people will trust themselves in different ways. They may say, I don't want a credit card, I'll just cut it up. That's what I recommend for a lot of people, is just to take a nice pair of scissors and get rid of the credit card. Personally, what I choose to do is just use my credit card for bills and holidays. Now, I actually get points for that, but I get points for paying my bills. And I don't use my card if they're going to charge me a surcharge for paying the bills, but I do if there's no extra charge for doing it. But I don't use my credit card, and I don't need to carry it around with me day to day in my wallet. I don't use it for tap and go pay, because that's just impacting in this area. I do use it to pay for my holiday depending on what's in my holiday account. So if I've got money in my holiday account and I want to buy tickets, then the credit card comes out. So credit cards can be introduced here, but really it's just a link to the bills and things like holidays. Now, I also forgot to mention again the buffer. Now, a buffer account is actually quite important, and it's a separate savings where it is to allow you for things like a period of redundancy or low income, or if you think you might be planning on having a baby or something like that, or you've got a property or multiple properties and you want to have some money just in case you need to do some repairs. It's better if you don't mix it with the long-term savings, but some people do based on having an offset account. And a buffer, an ideal buffer, the first target is to have 3 months worth of expenses. Expenses being the bills and all of this stuff. If you've got 3 months worth of that in a buffer, you're in a very comfortable, confident financial position. Once you've got past that point, you can stop moving money into the buffer account and focus on the long-term savings and other things. However, though, you might want to consider building up your buffer further, because when you get real financial comfort is when you can cover 2 years worth of your expenses in that buffer, because then money is not a worry anymore. It's not something you have to stress about. It's not something you have to have an argument about. You know that you've got money just in case, but you know it's in a separate place where you're not going to touch it. You don't have access to it because it's not with that bank. We want this stuff done with a different bank. Multiple banks if you like. Okay, I need to cover one more thing, and that's people say to me, but my everyday account has to have a minimum of $2,000 a month going in, otherwise I pay fees. Okay, well, not every bank charges you fees to have an everyday account. There are banks out there that don't. So do some research around those. I won't mention them. I'm happy to give an informal a comment on which banks do, but find a bank that won't charge you for the everyday and use them for that. If you've got a bank at the moment that makes you have $2,000 pay, you might consider using them for your bills account and just get rid of the ATM card or put it in a drawer at home and stop using it. So you could use your current bank for your bills account and get a new bank for the everyday, because you can't guarantee there's going to be enough coming in every week to cover it. One more thing is when you are investing, you've got a property and you have an offset account, people say, why don't I put all of my money into the offset account and I'll save money? The problem here is, going back to the beginning, people spend what they can access. The last thing you want to do is give yourself access every day to your offset account, your life savings. And mathematically, as another video, and I'll explain it to you, that it doesn't make any difference anyway. In fact, I did this for a couple the other day, and they have an average balance of $5,000 in their other accounts. And they said, well, if that's in my savings, that's earning me interest, or if it was an offset, that would be saving me interest. And I say, okay, how much interest will it save you? $5,000 at 5% will save you $125 per year. Sorry, won't it? It's $250 a year. What am I talking about? It's $250 per year. Now, is $250 per year going to make you wealthy and going to get you further ahead? And what's the probability in 12 months of having unlimited access to all your funds that you will overspend by your budget by $250 or more? Most people will say it's almost a certainty that you'll do it within the first month. So don't waste your time with those schemes. They don't work for any normal human being. And if you're a normal human being, then carry on doing this. Set up the budgets. Now, if you need more help, then please hit us up. We've got free budgeting tool that at the moment we're giving away to people. All we ask is that you get into contact with us, so we don't just publish it on the website, and we know who we're giving it to. And then we'll give that to you for free. And because I'm a bit of a geek, it does allow you to, for example, write down your coffees, nominate which account it's going to go into, and it automatically calculates for you how much needs to go into that weekly account, how much needs to be in the bills account, how much is in the savings, and how much is in the holiday. So if you've liked what you've heard, please like it, please share it, please pass it on. It is my gift to you. I get nothing out of sharing this information. It's called general advice. Other than a big smile on my face, because I know it makes a difference to people's lives. And the amount of difference it makes is typically somewhere between $10,000 and $20,000 per year. Think forward over the next 5 to 10 years what a difference that would make to your lives. So thanks for listening. My name is Max Phelps from Golden Eggs Home Loans.